Good morning and welcome to Financial Accounting. Today we are going to be continuing our work on Chapter 2. So in a moment when we get there, we will be picking up with the exercise 4 for Chapter 2. We've already done parts A and B together. You may have tried C on your own, but we're going to do C together to get us started today. We hopefully will be finishing up Chapter 2 today, and so assuming that we stay on track with that, the Chapter 2 exercises should be submitted for grading by the end of the day today. And then next class, which will be Monday, February 7th, the Chapter 2 problem should be submitted for grading by the end of the day, as well as the Chapter 3 pre-quiz, because next week we'll be covering Chapter 3. Chapter 3, as we look ahead, Chapter 3 is the final chapter for our first exam. And so as you're looking at that calendar, you'll notice Chapter 3 pre-quiz on Monday, exercises due on Wednesday, the problem due the following Monday. So once we finish that problem, or once you finish that problem, you will have done everything you need for the first exam. So we'll talk about this more next week, or probably maybe even the following week, but the official exam window is always a 4-day period. It's almost always Thursday through Sunday, but the last exam of the semester, because it's the end of the semester, I think the dates might be different than Thursday through Sunday. But officially, for exam 1, 2, 3, 4, the exam period is Thursday through Sunday. There is a time limit, so unless you have notified me of accommodations, you have 3 hours to complete that. If you have accommodations in place, then your time would be updated for you in CNow already. If you have accommodations but have not yet notified me of that, haven't sent me the letter from Don Poole, our accessibility coordinator, you should have a letter from him, and you can forward that to me, and I will take care of setting up any accommodations that you need. For this class, really the only typical accommodation would be extended time for testing because of the nature of everything else we do. There isn't time limits. We aren't doing any kind of testing in class where you need a quiet environment, because all of that is done outside of class, so you can identify your own environment in which to take the exams. Along with that exam, then the first part of the project will be due. So you need to have a company chosen and approved. I'm working on those approvals this week. I should have those all done by the end of this week. So if you haven't already chosen a company, make sure you get that posted to the discussion board in this real world annual report area. So right here where it says choose a company, that's the discussion board. You need to post to that board with your company's name as the subject line of your post, because everyone needs to be able to see what you've chosen, because no 2 people can do the same company. So if you haven't already chosen your company, please get that done. If I get through all of the approvals, once I get through all of the approvals, I will go through, and anyone who hasn't chosen a company, I will assign one to you. And I would prefer not to do that. I would prefer you choose your own company, so it's something that's of interest to you, not something that just pops into my head. So please post your company name if you have not already done that. And if you have chosen your company, make sure you keep an eye on the My Grades area in Blackboard. If you've chosen a company, if you look at this right now where it says choose a company for your report, you'll see a yellow circle here. What that means is you've submitted it. I haven't assigned the grade yet. Once, if you see a blue kind of circle there, not a speech bubble, but just a circly kind of thing, that means that you may have gone into the discussion board but didn't actually hit post on your post, which means I can't see it. So you should be seeing at this point either a grade, a number, either a 0 or a 5, or you should be seeing a yellow circle that says you've posted your company, I haven't replied. Once I put your grade in there, you will see a blue speech bubble next to the grade. That means that I have included comments, and I would encourage you to click on those comments, even if you got a 5, because sometimes I may give you a helpful hint or say something that is important. For most people, when I approve it, it's just going to say something along the lines of, thanks for choosing your company. Please let me know if you have questions. I'll be interested to read what you have to say about the company. If you submit a company and you see a 0 there, you absolutely need to look at the comments. You don't need to email me and say what happened, because I will have told you in my comments why the company you chose was not acceptable. Variety of reasons it might not be acceptable. It might be because someone else already chose it. It might be because it's not publicly traded in the United States. It might be because it's a subsidiary of some other larger parent company, and my comments then would be, can't do that company because it's a subsidiary, but you can do this company, which is the parent company, but I need you to tell me, yes, I want to do that company, the parent company. So please keep an eye on that in the gradebook. If you use the Blackboard app, I don't know how many people actually do, but if you use the Blackboard app, I know you get a notification when I put a grade in, so you'll know to go look at that. Any questions about any of what I've just gone over? Again, we'll talk more about the exam, I think probably not next week, but the following week once we finish chapter 3. So we'll talk, I'll actually show you the exam. We'll talk about what's on it, the formatting and everything like that, that week right before you take the exam. The project is not time limited. You are not expected, nor should you do the project while you have the exam open. They can be done totally separately. I know I said at the very beginning of the semester, what some people like to do is do each chapter part of the project as we do that chapter. So we finish chapter 1, you do chapter 1 for the project. We finish chapter 2, hopefully today, then you do the chapter 2 part of the project and just add it to the document that you've already created. Make sure you use a format, a file type that I can open, which generally means you should use Word. If you are an Apple person, that's fine. However, I am not. And if you give me a file that's in an Apple, what is it, .pages or whatever it is, I can't open it. So if I can't open it, I can't evaluate your work. You get no credit until you give me a document that I can open. So I strongly recommend using Word. Do not give me a link to a Google Doc. I think I said that earlier in the semester as well. It needs to be a static document, not one that you can go in and change after you've submitted the link to me. That's not acceptable. If you do that, I will just send you a note that says, not acceptable. Try again. Please do it right the first time. It's easier for everybody. Okay, so any questions before we get to our material? I know it's a little ways off, but just a reminder that we don't actually have classes at all. None of your classes will be meeting if you have face-to-face or time classes like this, live classes. We do not have classes on the 21st and 22nd. The 21st is President's Day, and the 22nd is a faculty workshop. So I will be working, we will be here, but you will not have class either one of those days. So if you are looking ahead to that exam and you want to think of that weekend as your break, that's fine. I'm perfectly fine with that. But please then plan to take the exam sometime after you submit the chapter 3 problem, which is due on Valentine's Day, the 14th, happens to be my mother's birthday. And you can take the exam anytime after you finish that chapter 3 problem. So if it works better for you to submit it on the 11th and take the exam on the 12th, that's fine. The exam is open. Don't test it right now, but you could actually open the exam right now. It's open. Everything for the whole semester is open for you right now. So, but I don't want you to try that exam, take the exam until you've finished all the work for these 3 chapters. All right, so any questions? So let's go to our exercises. As I said at the beginning, make that a little bigger. As I said at the beginning, we are going to be picking up with exercise 4, part C. So we did parts A and B together. We used T accounts to map out what was happening there. And I had suggested, I believe, that you could try C on your own. You can do that anytime you want, really. There are some people who like to work ahead in the exercises. They find it more beneficial to look at them in advance. It's not a requirement, but some people do that, and that's fine. And so maybe you have already tried part C on your own, maybe you haven't, but we're going to do the whole thing together. But I'm only going to use just one account today for this. Unlike what we did with parts A and B, where we had multiple accounts that I was showing you, talking about, you know, the various transactions. So the whole point of this chapter, the title of the chapter is Analyzing Transactions. And the whole point is getting in mind, how do we use accounts? How do we record transactions? The idea that all transactions must affect at least 2 accounts, that we use the concept of debits and credits to make sure everything stays in balance, and that every transaction is going to have an equal dollar amount debited and credited, whether we have just 2 accounts or more than 2. So what we did with A and B on Monday, last class, was talk about each transaction that would have resulted in the entries to the account that we were analyzing. The reason I'm not doing that here with letter C is because, as we mentioned last class, cash is the account that has the most activity in it. And so as we look at the things that happened in that account, it's not as helpful to talk about the other side of those transactions. Because it tells us, for example, cash receipts were some dollar amount. I don't know what those cash receipts were for. That's just a summary, a total amount that they're giving us there. And those cash receipts could have been for a huge number of different things. You know, any reason that someone might be giving us cash. So we're not going to really talk about, for this one, the other side of these transactions, but it is still the case, it is always the case, that the transactions have to have 2 sides. We can't have just a debit without a credit, or just a credit without a debit. There's always going to be both sides that balance. While I was talking, I labeled the T account, the debit side, which is just the left-hand side, the credit side, which is the right-hand side. As we said on Monday, you want to get in the habit of asking yourself the questions. Okay, so which account is it? What type of account is that? So we know that cash is an asset account. Because it's an asset account, it has a normal debit balance. So that's the other concept that we introduced on Monday. The normal balance refers to the side of the account that's used to increase that account. So cash is an asset account. Assets have a normal debit balance. So I've labeled that for now. I've labeled that with the plus to remind us that's the side we use to increase that account, and the minus, that's the side we use to decrease that account. At the beginning of April, it tells us the cash account had a balance of $46,220. We pointed out on Monday that you do not use dollar signs in T accounts. It's understood. These are dollars that we're measuring here. How did I know to put it on the debit side? Well, that's the normal balance for this account. It didn't tell us it was a debit or a credit balance. We make the assumption, if it doesn't specify debit or credit, we make the assumption that it has the normal balance for that account. So that's how I knew which side to enter that balance. Everybody good so far? What happened during April? Well, people paid us. I don't know why they paid us, as I already mentioned. Maybe we made some sales that were on credit, and now the customers are paying their bills, are paying off the receivable. So the credit side would be to the accounts receivable. Maybe these were cash sales, and so the credit side would be to a revenue account. I have no idea. Probably lots of different things happened that in total, our cash receipts were $248,600. But to be able to answer this question, to be able to do this exercise, all we need to know is when we receive cash, what impact does that have on our cash account? Does it go up or does it go down? It's going to go up, right? So we're going to record that dollar amount on the debit side to increase that account. We're going to record that on the debit side. And we know that there would be credits to one or more accounts that would in total be $248,600 as well. And then the next thing we're told is that the ending balance in the account was $56,000. Let me actually still, I'm gonna do one more thing here. I'm gonna leave us room for our footings so we're accustomed to how we balance an account. So we're told that the balance in the account was $56,770. What we're asked then is determine the cash payments made during April. So that's what's missing is this number right here. How much did we take out of that account? So how are we going to balance this account? Well, let's remember to balance a T account, we add up the debits and record that dollar amount that's referred to as the debit footing, the foot or the bottom of the column. We add up the credits, but we can't do that because that's the number that's missing. So that's the number we need to find. But we can, with what we have, add up the debits and find the debit footing. So let's go ahead and do that. I got $294,820, $294,820. So that's how much we had that went through the account in that month. What we started with plus what we added to it. In total, we had almost $300,000 in our account, but at the end of the month, we had only about $57,000. So the question is, how much did we spend? Well, it's about, just rounding off, about $300,000 minus $57,000. It's going to be about $243,000, something in that range. I'm just rounding. So how did I get that? I took the total of the debits and I subtracted what was left, and that will give me the total of the credits. So $294,820 is how much we had available to spend, and at the end of the month we had only $56,770 left. So it must be that we spent $238,050. Does that make sense? Everybody's good? You should be able to go ahead and click the check my work button here. Now, I'm going to click it, but I don't have the first two answers in because, as I've explained, I'm not able to save any of my work. So I start fresh each day, but you should now see that that exercise is completed. All right. And we will move on. So I've already explained, I've already mentioned a couple times those 3 questions we have to ask, we have to answer to be able to analyze a transaction. And those 3 questions were recognition, valuation, and classification. So the recognition is, what date do we put on it? Now in this exercise, we don't actually have dates, but where you see the numbers, 1, 7, 2, 3, 4, 6, 9, 3, 9, and so on, that's where we would put the date in the T account. And so for now, for this exercise, we're going to think of those numbers, identifying the transactions, we're going to think of those as the dates. So that's the recognition question. What date do we put on it? It's important to have those in part because it helps us to match up the debits and credits. So I'll show you here. So here's the number 1 debit, and here's the number 1 credit. So I can see that they match, that they're the same in total, 40,000 on the debit side, 40,000 on the credit side. This is going to be helpful if we run into a problem. If we find out at the end that our system, our accounting records are not in balance, that is, our debits and credits are not equal. It's what we're going to be talking about in the next exercises. So having those numbers or the dates are going to be helpful for us to go back and figure it out if something's missing, if something doesn't match up. So please make sure if you're writing these out, if you're using T accounts on your scrap paper, like I suggested you might want to do, please make sure that you're putting in the dates or the numbers, whatever they provide to you to indicate which transaction it is. You'll find that very helpful. So we've got the recognition, that's the date. Classification is the account, so you can see for these we've already answered which account is it, and then valuation, which is the dollar amount. So in order to do transaction analysis, we have to be able to answer all 3 of those questions. And what we're asked to do here, what we are asked to do is look at each one of the transactions based on the number and identify which account is debited and then answer, did that increase or decrease the account, and which account is credited, and again, does that increase or decrease the account? So I already identified for you transaction 1. We have a debit to cash for 40,000 and a credit to common stock for 40,000. So cash is what type of an account? An asset. And because it was debited and it's an asset, that would increase or decrease? Increase. The credit was to common stock. Which type of account is that? Stockholders' equity. And so crediting common stock has what effect? Does it increase or decrease it? It's on the credit or the right-hand side of the equation. So crediting common stock would increase that account. If you're not sure, that's fine. As I've explained, it takes a while to get used to this. And until you are absolutely sure that you know, I would just encourage you to keep this mnemonic in mind. If it helps you to print that out, I would encourage you to do that so you don't have to keep flipping back and forth between screens. That's, of course, fine and encouraged. So does everyone see what we're doing here? So the transactions have already been analyzed for us, and our job is just to think about what really happened here. So before we move on to transaction 2, transaction 1 is what we would normally refer to as the opening entry. In other words, this business did not exist before that entry. There was nothing in any of the accounts. You can see here, it's the first month of operations. So before transaction 1, none of these accounts had anything in them. in transaction one, the company received $40,000 in cash in exchange for stock. So someone, the owner or owners, invested $40,000 of their own money into this new company, Rocky Mountain Tours Company, the travel agency, and they took the ownership stake. They have the equity. So that's what happened there. How about number two? If I pull my arrows back up here. Number two, there's a credit and there's a debit right there, okay? So we have the $4,000 credit to cash and a $4,000 debit to supplies. What type of accounts are those? Cash and supplies, what type? They're assets. Yeah, there's something that we own or control that's going to help us run our business to make money. So assets have a normal debit balance, and so a debit increases that account and a credit decreases that account. So when we scroll down to answer the question, both accounts were assets. So the debit, the one that was debited, supplies, is increased, and the one that's credited, cash, is decreased. So what happened there? We bought some supplies. Absolutely. We bought some supplies and we paid cash for them. If we had bought them on credit, the supplies asset would still have increased, but it wouldn't have affected cash. It would have been a credit to accounts payable, the liability that increases that liability. And so we know, oh yeah, that's a bill we have to pay later. Make sense so far? Okay, let's see what happened in number three. So here's the debit for number three. A debit of $15,000 to equipment. Equipment is what type of account? Also an asset. Lots of assets going on. And that makes sense. This is a brand new company. At the beginning, they had nothing. Now they have some cash and they have to spend some of that cash to get the stuff they need to run their business, supplies and equipment. Yes, sir.
Why is there three different threes on the
Good question. So why are there three different threes? This is what we call a compound transaction. So we've identified the first part of it, the debit of $15,000. When we debit an asset, we know it's going to increase it. If you're not sure, you can look up at the first two we already did. You can look over at that accounting equation with normal balances over there. But as Stephen just pointed out, we don't have just one credit for $15,000. We have a credit here for $10,000 and another credit here for $5,000. So a credit to cash for $5,000. Cash is an asset account, right? So when we credit it, it goes up or down. When we credit an asset, it goes down, right? We used cash. So we got $15,000 worth of equipment in this transaction, and we spent $5,000 in cash, and the rest of it, the other $10,000 is right here, credited to accounts payable. So what did we do? We made a down payment and we charged the rest, right? We bought the rest on credit. Maybe we agreed to pay $5,000 a month for the next 2 months until it's paid off. Maybe like if you buy a car or a house and you put a down payment on, and then maybe you're going to spread that $10,000 over the next, I don't know, 6 months or 3 years or 20 years or 40 years if it's a house. I don't know. What I should probably point out is accounts payable doesn't include interest. So it's probably not a long-term payment plan we have here, because otherwise the seller would probably want to be getting some interest on that. But maybe we agreed to pay $5,000 down and then the other 10,000 next month. I don't know. If we were this company, we would know, right? We would have to know when is the rest of that due. We wouldn't just say, okay, bill us and, surprise us. We'd want to know that when we made the agreement. It will be in the contract, probably with the seller of that equipment. But as is frequently the case for our in-class examples, we don't have all the information. And so sometimes I'm just speculating about what might have happened, but I don't have any more information than you do. So I'm just talking about what might have been. So let's enter the second part here. So there is the second account that's credited, and we give us a second line here, is accounts payable. What type of account is accounts payable? Liability, exactly. So just to point this out, you'll notice asset was not on that list. And if I look at this one, liability was not on that list. And the reason the software does that is to kind of force you into putting them in the right order. Because if we had put the accounts payable first and then the cash, the software is not very smart. It's kind of cool, but it's not very smart, and it doesn't know that we could put those in either order and the answer would still be right. So it kind of forces us into putting them in the correct order. By correct, I mean the order it expects, because it has to be coded to say what the correct answer is, so it gives you the green check marks that we're looking for. So it is not the case that we could not have done the accounts payable part first. If we were writing a journal entry to record this, we could have put the two credits in either order. There's not a correct order to put them in the journal entry. The only thing that matters, as we have here, is that the debited accounts are listed first and then the credited accounts are listed second. But when we have multiple credited accounts like we do here, cash and accounts payable, there's no correct order for those to appear as long as they're after the debited account. So when we credit a liability, does it increase or decrease? Do we owe more or less after this transaction? It's increased. We owe more. We owe whoever the supplier is. We owe that entity $10,000 that we didn't owe before we bought this equipment with a down payment and a promise to pay the rest later. So back to Stephen's question about why do we have three parts? Well, this is what's called a compound transaction. And most of what we do, and if you look at this, you can tell that all of the rest of these transactions, so 8 of the 9 of these transactions are simple transactions. One debit, one credit, equal dollar amounts for each. This is a compound transaction, which means that there are more than 2 accounts. There still have to be at least one debited and at least one credited. So we couldn't have a transaction with 3 accounts that are all credited. We still have to have at least one debit, at least one credit, and in total, the dollars that we debit and credit have to be equal. And we can see that that's true here. We have a $15,000 single debit, and then we have the 2 credits for 5 and 10. So obviously that equals 15. And so we do have the same dollars debited and credited, even though we have multiple accounts. Most of what we do are simple transactions, but we do occasionally run into the compound transactions. If you press me, I'd probably have to say in the real world of accounting, we're at least as likely to see a compound transaction as we are a simple transaction. But we tended to do things at the basic level with the recognition that if you understand how it works, then you can build on that. Stephen, did that answer your question?
Yeah.
All right, so that's number 3. How about number 4? Arrows back up here. So here's our credited for. These are debited for. Okay. So there's the debit and the credit. We can see that they are both equal in dollars. So the credit is to cash. You can see, as we've already pointed out a couple times, cash is the most active account. It has a total of 7 transactions recorded in the cash account, or no other account has more than 2. Because a lot of the transactions, one side or the other, is cash as we're running our business. So we have a credit to cash and we have a debit to operating expenses. Now that operating expenses debit is just a summary. We would have separate accounts for each of those, and it could be wages expense and utilities expense and telephone expense and the CEO or the president's salary, all those kinds of things, insurance, taxes, whatever else we're paying for. We're just lumping them together here into one category. But the debit is to operating expenses. So as is almost always the case, an expense will include the word expense in the title. And if you see the word expense in the title, it's almost always an expense account. Now we talked about sometime, it may have been last class or the class before, we talked about that account called prepaid expenses, and we pointed out that's not actually an expense account, it's an asset. But most of the time, if it's an expense, it will say expense right in the title. And if you see the word expense, other than that prepaid expense kind of thing, if you see the word expense, you can expect that it is an expense account. Expenses are on the right-hand side of the equation, but they decrease our equity. The more money we have to spend, the less money we get to keep in our earnings. And so debiting an expense account increases that expense account. Again, if you're not sure, go look at that reference material. And the credit was to cash. We've done this several times already. We know cash is an asset, and if we credit an asset, we are decreasing it. We spent money on those expenses. Number 5, what do we have here? So here's our credit, service revenue, and our debits right here in accounts receivable. So what happened there? Did they pay us yet? No cash involved, so they haven't paid us yet. But what did we do? We provided them some service, right? We sold them something, right? I don't know what. We're a travel agency. We sold them plane tickets and charged them a fee for the service that we provided them. I don't know. So we earned that revenue. In chapter 3, we'll talk about, well, how do we know we earned it? But for now, it said we earned it. We'll just take their word for it. We earned the revenue. So we increased the revenue, thereby increasing our income, but our customers haven't paid us yet. And so here, the debit side is to accounts receivable, which is their promise to pay later. So the debit side is accounts receivable. What type of account is that? An asset, absolutely. It's an asset. So debiting an asset, we know increases it. And the credit side was to revenue, exactly. And most of the time, our revenue accounts will include the word revenue. If I got to have a say, it would always include the word revenue. And most of the time, if you see the word revenue, it is a revenue account. Just like we have prepaid expenses, there's a similar account for revenues called unearned revenue. And we'll talk about that. We don't have to talk about that right now, but we will talk about it soon, shortly. And if you see the term unearned revenue, that's actually a liability for us. What it means is someone paid us and we haven't held up our end of the deal yet. So we haven't earned it. It creates a liability for us because at some point in the future, we owe them whatever it is we sold to them. maybe it's a service that they paid us in advance. You know, this time of year, I think sometimes you pay a contractor to keep your driveway or your parking lot plowed as a business. So you might pay them up front for the winter, and then they just show up and they earn it as they come and plow or as time passes. But other than that unearned revenue, most of our revenue accounts are going to include the word revenue. And if you see the word revenue, you can, other than unearned revenue, you can expect that that is a revenue account. And revenues are on the credit side of the equation. And if our revenues go up, then our equity goes up. So crediting a revenue account increases it. Are you kind of getting the hang of this? Is there anyone who's just shaking their head going, no? Okay. It might sound like I'm banging the same drum over and over, but this is the foundation of how we do the bookkeeping part of accounting. And so you really have to understand how this works. It's very important. Let's look at number 6. So we have right here a debit to accounts payable, and here we have a credit to cash. What happened there? Let's look at what's happening in the accounts payable account. So why did we reduce our accounts payable? Because we made a payment, right? We used cash to make a payment, but why did we make a payment? Did we buy something new? No. What is that from? Why did we owe this $10,000? For the equipment. So back here in transaction number 3, we bought some equipment and we didn't pay for all of it. So we recorded this liability that we still owed $10,000 on that equipment. Now, in transaction number 6, we've paid off a good chunk of that, not all of it. How much do we still owe on that equipment? We owe another $4,000. How did we know that? Well, we took the credit total and we subtracted the debit total because it's lower. We subtracted that $4,000, and we would record that on the side that has the higher total, that is the credit side. We still owe $4,000. But to do this exercise, let's see what happened. The account that was debited was the accounts payable. Accounts payable is a liability. We owe someone. So when we debit an accounts payable, it reflects that we owe them less now. Or maybe we paid the whole thing off. We didn't in this case, but maybe we could have. So we decrease the liability by debiting it. And the credit we can see right here is to the cash account. And we already know, we've done this a couple times now, cash is an asset. When we spend money, our cash account goes down. When we credit the asset, it is decreased. Number 7. Let's see, here's a credit labeled number 7, and here's a debit, same dollar amounts. So what happened? We received $13,100 in cash. We credited the cash, or sorry, we debited the cash account. Why did someone give us $13,100 in cash? Because we had sold them something. When did we sell it? Well, we sold it back here in transaction number 5, right? So in transaction number 5, we recorded a sale, or a bunch of sales, totaling $20,500, and our customers hadn't yet paid us, but they promised we'll pay you later. And now in number 7, they have made a good chunk of that payment that they owed. So we received cash. The debit side is to the cash account. That's an asset, and it's going to go up. But the credit side is to accounts receivable, which is also an asset, and it's going to go down. Why did it go down? because our customers don't owe us as much anymore. How much do they still owe us? Well, they owed us $20,500. They paid $13,100. They still owe us another $7,400. After these transactions, the balance in the accounts receivable is $7,400. That's how much we are still owed from our customers. How about number 8? We have a debit to operating expenses and a credit to supplies. So the debit to operating expenses, what type of account is that? Yeah. And so debiting an expense, we already know, increases it. The credit was to the supplies account. What type of account is supplies? An asset. So when we credit the supplies account, what does that do? Decreases our supplies. So what happened? We used up some of those supplies. Back in transaction 2, we had purchased $4,000 worth of supplies, but then we started using them to run our business. And at some time, maybe at the end of the month, we looked at that and said, we don't still have all those supplies. We've been using them, and we calculate in some fashion. We calculate how much we have used or maybe how much we have left, and we then can back into how much must we have used. Last one, transaction 9, not exercise 9, but transaction 9 includes a credit to cash. And here's the debit. Dividends. What are dividends again? Yeah, we pay them out to our stockholders. It's like a reward, a thank you. It's how you make, it's one of the 2 ways that you make money by investing in the company. So remember at the beginning of this in transaction 1, someone or a group of investors put $40,000 into the business. And so we had $40,000 in cash and $40,000 in equity. That owner or those owners are now getting a return on their investment. $15,000 was paid out to the investors. And so the debit is to dividends. Now dividends is a special kind of account. Sometimes it's listed, sometimes, and we've already seen this in an earlier exercise, sometimes they just lump it in with stockholders' equity. But they actually gave us the option of dividend. And we talked about last class that dividends are kind of like an expense, kind of, in that the more we pay out in dividends, the less of our earnings we retain inside the company. And that's true for expenses as well. But we talked about the special nature of dividends, that they don't actually help us make money, and therefore they're not an expense, and they don't appear on our income statement, and they're not tax deductible. And so we talked about that in the context of the double taxation of corporate profits. But debiting a dividend does increase the dividend and decreases our equity in the long run. And the other side of that was, where did the dividends come from? Well, we paid them in cash. So the credit side was to cash, which for the about 10th time, crediting the cash account decreases that account. So click the button. We've got all our green check marks in there. We've talked through 9 more transactions, so hopefully you're getting the idea of how we go about doing this. Before we move on, does anyone have any questions? We will keep going then. And I need to go over to the PowerPoint for just a minute and talk about, before we can answer questions about a trial balance and finding errors in the trial balance, we need to know what the trial balance is. I have mentioned at least a few times in the last couple of classes the importance of having our debits and credits be equal. The trial balance is how we can check that. So we've been careful as we looked at those last 9 transactions, we've been careful to make sure each transaction had equal debits and credits. And I promise you, as long as every transaction has the same dollar amounts debited and credited, we don't have to worry about that. But we do still need to check it. And the way we check it is through the production or creation of a trial balance. So as always, don't worry about trying to write down everything that's in the PowerPoint. You do have access to these, the student version of these PowerPoints on the companion website. There's a link to the companion website right in the Cengage content area in Blackboard. So please don't feel like you should be copying all of this down unless it helps you to remember it by writing it. And that's true for some people. So if you're that person, feel free. Not telling you don't take notes, telling you if you're taking them just so you have them, you already have access to this, basically the same PowerPoint. We're going to see an example of a trial balance in another slide or two. So I just want to talk about what's in there and then I'll show you what it looks like. So at the top of the trial balance, we have a heading that will look very much like the heading on our financial statements that we've already discussed. But a trial balance is not a financial statement. It is a report. And that's an important distinction because in our financial statements, we don't use debits and credits. We just write the numbers. But this report must have the debits and credits because that's kind of the reason we do it. So we'll still have the heading at the top, name of the company. It'll say trial balance, and then the date. It's just like the balance sheet, it's a specific date, as of this date. And in reality, when you are preparing a trial balance, and virtually every company uses accounting software, you're just going to ask the software to print a trial balance for you. And it's not just the date, it's also the time. So you have a timestamp on that because as you're finishing up your accounting work for the period, for the month or the quarter or the year, you're going to be making changes. And so the trial balance you print at 10 o'clock in the morning might be different than the one you print at 11 o'clock or at 2 o'clock in the afternoon. So it's not just the date that's important on that report. Then, so we have our heading. Then we list all of the accounts. I'm not sure whether we've talked about this. So I need to point out that these accounts are listed in a specific order. Every company has something referred to as the chart of accounts, or COA, chart of accounts. And that is a listing of all of the accounts that they have ever created and used in their accounting records. And some of them might have balances in there and some of them might not. It might be that there are some accounts that are kind of holdovers. And so we used to use them 5 years ago, but we don't use them anymore. But they're still in our chart of accounts. That chart of accounts has a very specific listing, and it, not coincidentally, is the same order that we've been looking at these, and it's the same order they appear in that expanded accounting equation that I keep showing you in the reference materials. And this is the order: assets, liabilities, stockholders' equity. So we start with our common stock and retained earnings. Those are the permanent equity accounts. Then, we'll keep this in the parentheses. Then we go to our temporary accounts: dividends, revenues, and expenses. Okay. So the accounts in the chart of accounts are listed in that order. When we prepare a trial balance, the accounts need to be listed in that order. We can even get a little bit more specific than this. Our assets are listed, and I know we've mentioned this once before. Our assets are listed from most to least liquid. That is, we start with cash and we go down from there. Things that are going to be used up or turned into cash more quickly are more liquid, they're closer to cash. They're going to appear near the top of the list. And the things that are going to be around for a while, our buildings and equipment and so on, are going to be down near the bottom of the assets list. Liabilities, we also typically order based on when they're due. And so the ones that are due sooner are going to be near the top of the list, and the ones that are more long-term, like mortgages or bonds, are going to be down at the bottom of the list. So when we talk about listing the accounts, they must be listed in this order. It is not correct if you list them in any other order. Sometimes it's hard for us to know of two assets, which one is more liquid. And that's where the software is going to be helpful for us, because as I just pointed out in that last exercise, sometimes it doesn't give us all the options. So it kind of forces us into the correct answer because it doesn't allow us to put things in the wrong order. So we always start with cash and our assets, but then how do we know whether it's receivables or supplies or inventory that should come next? Software is going to guide us with that. In an actual company, the chart of accounts dictates the order of the accounts on the trial balance, because you're going to number the accounts based on this setup. So for example, your assets probably start with number 1, liabilities start with a 2, the permanent equity accounts and dividends usually start with a 3, revenues might start with a 4, and expenses with a 5. So they're going to print in numerical order, and based on the way we set up the accounts, we're going to have the numbers be in that correct most to least liquid order that I just mentioned. Then for each of the accounts, we're going to have next to the account, we'll have 2 more columns. So we have account titles, account numbers if we have those, account titles, a debit column, and a credit column. And we would put the balance of each account in the correct debit or credit column. The next step is to just total the columns. It's called proving it, proving the ledger. We total them and make sure that the totals are the same. Okay, totals have to be the same. It's kind of weird in my mind that they introduced this in this chapter, because we haven't talked about enough to be able to distinguish this. So I don't know why they throw this in, because it tells you right there the latter 2 are prepared in later chapters. I don't know why they have to throw that in here. But in chapter 3, if you look at the title of the chapter, I think the title of the chapter is something like the adjusting process. So we're going to learn about adjustments next week. And once we know about adjustments, we will have an adjusted trial balance. So for today, for this chapter, because we don't know anything about adjustments, we don't know anything about the closing process yet, for some reason they feel compelled to point out that this is an unadjusted trial balance. We don't even know how to do adjustments yet, but you'll know next week. Really not a necessary distinction in my mind at this point, other than it kind of gives you a sense of where we're going, maybe. So what's on the screen right now is that visual, that example of what a trial balance looks like that I already mentioned. Heading, listing of the accounts, and the account numbers. They do follow that same pattern that I was describing. One's for assets, most liquid is cash, so it's 11. Least liquid of what we have is office equipment, so that's 18. The 2s are our liabilities. The 3s are our permanent equity plus dividends. 4 for revenues, 5 for expenses. We list the dollar amount in the correct debit or credit column. This also gives you a bit of a sense of whether you've done things correctly, because we know assets should have a debit balance and they are all in the debit column. Liabilities should have credit balances. Dividends and expenses should have debit balances. And then we have our totals at the bottom, and we have proved that the ledger is in balance. Now where we're going with our next exercise is okay, it's in balance, but does that mean it's right? And the answer, unfortunately, is no. Sometimes we have mistakes that are not picked up in the trial balance. But we can see now the types of mistakes that would be picked up in the trial balance. And those mistakes are ones that would make our debits and credits be unequal. So the only way that can happen is if we put an entry in that has unequal debits and credits. As long as every entry is equal, debits and credits, our trial balance will stay in balance, our system stays in balance, our equation will stay equal. It has to. And so the only types of errors that would be picked up in the trial balance are errors where we put in a transaction that does not have equal dollars debited and credited. But there are lots of other things that could make our trial balance be wrong, that could make our accounting records be incorrect, but wouldn't show up in the trial balance. And we're going to see that in our next exercise. But now you know what a trial balance is. You can see visually what it looks like and what the purpose is. I'm unsure why they don't have dollar signs. I would normally put dollar signs in my trial balance, top of the debit column, top of the credit column, and then on the totals at the bottom. So I don't know why they don't have them there. But let's go back to our exercises. Does anyone have any questions about what we've done so far? Okay. So in exercise 6, we're given 5 different transactions or 5 different scenarios, and they're telling us up front, these are not right. There's an error here, and the question we have to answer is, would that error be picked up in the trial balance? In other words, would it make our debits and credits be unequal in total? I want to do a little bit more than that. So I want to talk about each one of these transactions and say why it's wrong and what it should have been. And then I'm just going to make a note, because what we need to do, as you can see, is pick, which of these combinations would cause the trial balance to be unequal, and which, then the second thing is which would require a correcting entry. So we're going to talk about each one of these separately. And for each one, we're going to answer both of those questions. Would it make it unequal? Does it need to be corrected? Let's look at letter A. A fee of $21,000 earned and due from a client was not debited to accounts receivable or credited to a revenue account because the cash had not been received. So this is a little bit tricky at this point in our, in chapter 2, because remember I said a little bit ago in class, we'll learn in chapter 3 how to know if we've earned the revenue. But I'll give you a little bit of a heads up. Whether we've earned the revenue or not has nothing to do with whether our customers paid us. Nothing to do with whether cash changed hands. So the key word in this transaction is it says we have earned those revenues. So when we've earned them, we want to report them. We want to claim those revenues. We want them to show up on our income statement because we've earned them, regardless of whether we have actually sent a bill, regardless of the agreement that we have with our customer about when they will pay us. The fact is, according to this exercise, we have earned those revenues and they should have been recorded. It should have been a debit to accounts receivable because they owe us the money because we earned those revenues. And it should have been a credit to the revenue account. But basically, we just left the transaction out. Should have been recorded, it wasn't. Is that going to cause our trial balance totals to be unequal when we leave a transaction out? Is it? Remember, the only things that are going to cause it to be unequal is if we put in a transaction that has unequal totals. So when we just leave a transaction out altogether, the trial balance will still be in balance. It's wrong because we should have put this transaction in, but the trial balance is not going to pick that up. And so I'm just gonna put a note here that says not, whoops, not A, to remind me that A should not be on our list because it does not make our trial balance unequal. We didn't put anything in. Wrong won't be picked up in the trial balance. Since we didn't put in an entry at all, we don't need to do, and this is the answer to the next question, we don't need to do a correcting entry because a correcting entry is for when we put in an entry that is not correct. We do need to put in an entry, but it's not a correcting entry because that implies we are correcting something that's already in there and it's wrong. So as I said, that one's a little bit trickier because it requires a little bit more of a background, which is why we're talking about each one of these. Okay, questions about A? So for our answers for the two questions, neither one of them should include A. Because no, it's not going to pick up in the trial balance, and no, it doesn't require a correcting entry. And let's move on to B. A receipt of $11,300 from an account receivable. So that what that means is our customer paid us $11,300. And it was journalized and posted as a debit to $11,300 to cash. Well, they paid us. We now have the cash. So that part's correct. We debited cash to show that our customer paid us. That part's correct. And a credit of $11,300 to fees earned. That's that revenue account that we've seen before. But why did they pay us? They paid us because we had a receivable. What that tells us is that the revenue was already recorded because the original entry would have been a debit to the receivable and a credit to the revenue. When they pay us what they owe us and we report it as fees earned, we've just recorded the revenue again. So we've now booked that revenue 2 times. Same time we billed them and recorded the receivable, and now we recorded it again. Oh, and by the way, our books still show us that they owe us that money because it's in the receivable and we didn't take it out. So that's wrong, right? The credit side is wrong. The credit should have been to accounts receivable instead of to the revenue account. But would it make our trial balance be out of balance? Are the debits and credits equal in this transaction? Yes, they're equal in this transaction, and so it would not make the trial balance out of balance. But again, it's not correct. We know that all of these are errors. It's not correct because we used the wrong account, but we debited and credited the same amount to each account. We just used the wrong account. So that one's not B either. Does this require a correcting entry? Yes, because it's wrong. Because we now have overstated our receivable, the asset, and we've overstated our revenue, which will overstate our income and then our equity. So it's wrong and it needs to be corrected. But the trial balance is not going to pick that up. When might we pick that up? When we send the next bill to the customer that still shows they owe that $11,300 and someone has a little panic attack and calls our billing department and says, we paid that. And then they go looking into it and they're like, oh yeah, there it is. I can see your payment, but we didn't report it correctly. That might be how it happens. We don't really want that to happen. We don't want to bill to get to our customers for something that they already paid. That probably would not make them very happy. We certainly don't want it appearing in our financial statements that way because it overstates our assets. And one of the principles that guides what we do in accounting is the principle of conservatism, which means when in doubt, we want to make sure that we are understating our assets when there's any question. Overstating our assets is definitely a no-no. Questions on that? Let's look at C. A payment of $49.50 to a creditor was posted as a debit to accounts payable and a debit to cash. Is that a problem? We have two debits and no credits, right? Is that going to make the trial balance totals be unequal? Yes, because we have two debits and no credit. So far, we have C that is going to make the trial balance totals be unequal. Is it going to require a correcting entry? Yes, because it was not correct. Whoops. So I can list these both over here. So B required a correcting entry and C required a correcting entry so far. So what should it have been? What part of letter C is not correct? So should we debit accounts payable? That's the liability. So when we pay our creditor, do we owe them more or less than we did before? We owe them less. So we would want to debit accounts payable, right? To show that we owe them less. Debiting that liability will lower our liability, decrease it. But how about a debit to cash? What does that do to our cash account? It increases it. Do we have more money after we pay our bill? Again, that'd be kind of a cool thing if it worked that way. I'd be paying bills all day long. Hey, let me pay another bill so I get some more money. It's not how it works. So that should have been a credit to cash. So our correcting entry is going to be to move that payment from being a debit to cash to being a credit to cash. Now, in a perfect world, let me just point out, in a perfect world, our accounting software would catch this before it even got in there. So we would try to put this in and it would say, you can't do that. Your debits and credits aren't equal. It should work that way. Some softwares do work that way. Others, unfortunately, do not. How about letter D? A payment of $5,000 for equipment was posted as a debit of $500 to equipment and a credit of $500 to cash. So our first question, we have a debit of 500 and a credit of 500. Is that going to make our trial balance out of balance? The answer is no, because the debits and credits are equal. What's the problem? It should have been 5,000, not 500. So if we had made one of them 5,000 and the other 500, yes, the trial balance would be unequal and we'd have to correct it. Do we have, let's talk about, we know the dollar amount's wrong. How about the accounts? We bought some equipment. We debited equipment, that's an asset, so debiting it's going to increase it. That part's right, because we have more equipment than we had before. And we paid cash for it, so we definitely want to credit cash. So we would still need to do a correcting entry. We would need to do a correcting entry to make up that $4,500. And in an upcoming exercise, might even be the very next one, we will see how do we do those corrections. There's a couple different ways you can do it. One is to just undo the entry you already did. We don't erase things, we don't delete things in our accounting records. It was in there, we don't take it out. But what we do is called reversing it. So wherever there was a debit, we credit that account, and wherever there was a credited account, we debit that, and it cancels out that entry. But there's still the trail for our auditors, and that's really important, that we have the trail of here's what happened. So one way is to simply reverse the entry that was wrong and then put in the correct entry. And that's a two-step process. The other one is just a one-step process where we put into just one entry whatever we need to make it correct. So in this case, we would have debited equipment in our correcting entry. We would debit equipment for the other $4,500 that was missing and credit cash for the other $4,500 that was missing. That would be the one-step approach.
We couldn't just go back into the program and add a zero.
Nope. Not once it's in there.
That would
Yeah, no, don't do it that way. and there's a reason we don't do it that way. The reason is because we may have printed and shared reports based on that wrong information.
But
If we
like,
remove
if it
it-
was before and you like you put it out, or you just noticed.
Yeah,
it
if you
before.
hit the button and said, oops, didn't mean to do that. Accounting software will allow you to delete things. But, and if it's that instant, oh shoot, I shouldn't have done that, you can go in and edit, you can go in and delete. But you want to be super careful about doing that. And if there's any kind of doubt that someone else in this organization may have printed a report with that wrong information, you can't just delete or edit it, because then there's not the trail of why did that happen, and that raises red flags for our auditors, who are going to look at that and say, you have two different reports out here. How can that be? These numbers don't match. Where did this come from? And that raises the question of what else did you change and delete that shouldn't have been. It's just a big no-no in accounting. You do not erase. When we used to do things on paper, you didn't erase, you put a single line through it so you could still read it. You don't delete, you don't edit. If there's any question that someone may have already seen that or printed a report that shows that wrong information, you have to have the trail of, here's what was in there, here's where we fixed it, this is what it should have been. I know it sounds nitpicky, but it's super important that you don't do that. Your auditors will be all over you with a fine-tooth comb if they think that you have been fooling around with the financials. That you're putting one thing in and reporting on that, and then not just fixing it, but actually deleting and changing things. You definitely cannot do that. Should rephrase that. You can do it because the software will allow you to. It's a really bad idea. Definitely frowned upon. Let's look at letter E. Payment of cash dividends of $19,000 was journalized and posted. So we already saw how dividends work. We saw that in the last exercise. So we would debit dividends and credit cash. In this case, we debited salary expense and credited cash. So we've got a wrong account in there. Just having the wrong account doesn't get picked up by the trial balance, but what else happened? The debit was for, the debit was for 1,900 and the credit was for 19,000. So does that get picked up in the trial balance? Definitely. It definitely does get picked up in the trial balance because they're unequal totals. It also needs a correcting entry because the totals didn't match and we used a wrong account. Now I should point out, if your software actually lets you post a transaction that's not in balance, the entry to correct it also can't be in balance because you're trying to bring it back into balance. So as I said, ideally the software prevents you from doing that altogether. But if you have one entry that's out of balance, you're going to need another entry that's out of balance in the opposite direction to bring it back into balance. So now we have what we need to be able to pick our answers. So the answer for the first one should be C and E, and the answer for the second one should be B, C, D, and E. Okay, any questions about that exercise? Or what we've been talking about so far. Here are my pictures, and we'll keep going. I'm getting a little concerned that we may not finish today, and that's fine. If we don't finish today, I'm actually going to pause the recording just for a moment. Hang on a second. Okay, so I took a little break to look at the chapter 2 problem, because we are not going to finish. We have 4 exercises left. We do need to carry some of this over to next class. So what will happen is the chapter 2 exercises will now be due on Monday. And I'll put this in the announcement after class as well. And I'll change the dates in the Blackboard calendar and in Cengage, so you have them in all those places. I will not change it on the syllabus, the hard copy of the syllabus. So the chapter 2 exercises will we do on Monday the 7th. I just looked at the chapter 2 problem because I wanted to see if we have done everything that you need for that problem, and we have. So the chapter 2 problem will still be due on Monday as originally scheduled. Okay, so the only due date that is changing is the chapter 2 exercises, and I will put that in the announcement after class so you have it in writing. As you know, you always have the time you need to do the work anyway, so it's not like it would get closed in Cengage, but I'm officially extending this to Monday because we will need more time at the beginning of class on Monday to be able to finish up some of these exercises, whatever's left at the end of class today. But you should be able to do everything that's on the problem we have already covered. Okay. Questions about that? Make sense? Entries to correct errors. So we just went through 5 different types of errors and talked about, will this show up in the trial balance? Does it need correcting? And we saw that most of the errors, even if they didn't show up in the trial balance, they still needed to be fixed. The only one that didn't need to be corrected was the one where we had just skipped an entry. We need to put that entry in, but it's not considered a correction because we hadn't put it in incorrectly. It didn't need to be corrected. It just needed to be put in the first time. For this exercise then, we're given 2 different errors and we're asked to fix them. And this is going to show us what I just mentioned a few minutes ago with our first error. How do we fix that? There's a 1-step and a 2-step process. So in letter A, we're going to use the 1-step process, and in letter B, we're going to use the 2-step process. There's not one of these that is more correct than the other. I have my preference, and you might have even picked that up as I was describing it. Maybe not. My preference, if I was doing a correction, my preference is to reverse the entry that was wrong and then put in the correct entry. So my preference, even though it's less efficient, is the 2-step process because I think it's easier to see exactly what needs to happen. But either one is acceptable. Either one is perfectly acceptable. As I already mentioned, what's not acceptable is deleting the wrong entry or editing the wrong entry. You do need to correct it using one of these 2 approaches. So letter A says cash of $8,800 received on account was recorded as a debit to fees earned and a credit to cash. So here's our format for a journal entry. Just as a reminder, we would have the date, debited account or accounts listed first, credited account or accounts listed after that, dollar amounts in the correct debit or credit columns, and in total our debits and credits need to be equal. So I think to help us see this, I'm going to put on the screen what the original entry actually looked like. So it says we debited fees earned, so that would have been listed first, 8,800, and we credited cash for 8,800. That's the original entry. There's so much wrong on this. The whole thing's wrong. One of the accounts is wrong. The debits and credits are reversed. So what do we need to fix? Well, we received cash, so we should have been increasing our cash, right? How do we increase our cash? Do we debit or credit? We debit. So we took $8,800 out of our cash account when we should have been putting $8,800 in. So the entry to fix that is going to be a debit to cash, but it's not just for 8,800. We put 8,800 in, we're just back to 0. It's as if nothing happened to our cash. We need to actually put in twice that amount, or 17,600, to fix the error that we credited cash. So to wipe that out, we have to debit 8,800. And then we need to debit another 8,800 to show that we're actually putting more cash into our account. So because we credited when we should have debited, it's off by twice as much as the original entry. Does that make sense? Now, how about this fees earned? This says it was received on account. So we've already seen this in an earlier exercise. We set up the account receivable when we recorded the revenues. Now we just debited the revenue account, which basically wiped out the revenues we had already recorded. We shouldn't have been doing anything with revenues at all here. We should have been crediting what? Receivable. So two things we need to do to fix this. We need to reverse the debit to fees earned. That shouldn't have been in there at all, so I'm just going to zero it out. We debited 8,800. When we credit 8,800, it gets rid of it. It's zeroed it out. It's like it didn't happen. And then we can credit the correct account, the one we should have been crediting the whole time, accounts receivable. Our customers have just paid us $8,800 that they owed us, so we need to show we have the cash and they no longer owe us that money. We want to decrease the receivable. Receivable is an asset, so to decrease it, we need to credit that account. So that's the one-step process. If we were really doing this, we would have the original entry right in front of us. I wrote it on the screen to make sure we were thinking we could see what happened. So that's the one-step process. We just fixed the original entry. Make sense to everybody? So let's look at the two-step process in letter B. In letter B, it tells us to prepare the entry to reverse the original entry first. So that means whatever we did in the original entry, we just want to do the opposite. If we debited, we credited. If we credited, we debit to reverse it. So what does this tell us? A purchase of $1,760 of supplies. We bought them with cash, and we recorded it as a debit to supplies expense and a credit to accounts payable. So we're going to do the opposite. We debited supplies expense, so now we're going to credit supplies expense. We credited accounts payable, so now we're going to debit accounts payable. So that's called the reversing entry. It just wiped out or canceled out the original entry. And now it's as if we never made that original entry, but as I've been pointing out, we can still see that it happened. We go back in our records, we can see the original entry, and now we can see the correction, the reversing entry to get it out of there. And now it's like we're starting from scratch, and we can put in the entry as it should have been in the first place. So we bought some supplies and we paid cash for them. The debit should be to supplies. And the credit should be to cash, because we used cash to do that. And so in the two-step process, we first reverse the entry that was wrong, do exactly the opposite, whatever we did the first time, do the opposite to clear it out, and then we put in what the entry should have been.
Was there a reason you put like accounts payable first, or is it just for?
You always list the debited accounts first. Yeah, yes, good question. So refer back to this required form for a journal entry, and you'll notice, and I explain it down here too. The debited accounts have to be listed first. The credited accounts always get listed after the debited account or accounts. And you'll notice there's an indent here. And if you haven't noticed it already, our software automatically, as soon as you type a number in that credit box, it automatically indents. So I like to point that out, because if you were writing this by hand, you need to remember to indent. The software does it for us, and you might not even notice that it's doing it. Get my green check marks in there. And so now we know what types of scenarios would need a correcting entry, and we know the two different ways that is acceptable to do those corrections. Just fix it or reverse it and put in the correct entry. Either one is fine. I prefer the second way, but that's just me. questions so far? Let's move on then. So remember I told you in an earlier class, when you see that Y in the date, in the year like that, that's not a real thing. That is an accounting textbook, accounting authors thing to make it look kind of more contemporary, I guess. So if this had said 2009, they'd have to update it to 2019 to make it seem more contemporary. If they just put in the Y, you'll hear me say the closest year to what's there. So I'll stick in a 1 or a 2 as appropriate. You're never going to see that in a real accounting setting. You put the actual year, not this Y business. But the textbook I used for the first 15 years I was teaching accounting used an X. So, you know, it's something maybe you can ignore it, pretend it's not there. So what we're doing in this exercise, and this is the only time we'll do this semester, I know it's tedious. What we're doing in this exercise is just seeing what the accounting software does for us. So we're going to do it by hand, but we only do it once just so you can see it. And the whole reason is because I think it's important that you understand what's happening in the background. So we're going to journalize a transaction in part A, and then we're going to post the transaction to the ledger. So this is an example of a general journal form. The general journal is sometimes referred to as the journal of original entry because it's where the stuff, where the information, where the transaction analysis gets into our records. And from there, we have to update the individual accounts. So the journal entry includes at least 2 accounts. But then we need to know what impact does that have on those 2 or more accounts. So we need to update their balances in the ledger. The ledger is organized by account. And so for each account, you can see what was in there, what was the beginning balance, what happened, and what, you know, what's the balance as you go through the accounting period. So the first thing we have to do is journalize this transaction. On February 11th, so we now actually have a date instead of numbers or letters like we've had. Quick Fix Company purchased $2,250 worth of supplies on account. So what are the 2 accounts that are going to be affected when we buy supplies on account? Supplies. Supplies is an asset. So do we have more supplies or less after this? More. So supplies is an asset, and we want to show that we have more of that asset. So I'm going to debit supplies for $2,250. Leave the posting reference blank for now. Posting reference tells us what happens when we post. We're not posting yet. We will in a second. What's the other account that's affected? Did we pay cash for them? Yep, so we bought them on account. So what account would that be? Accounts payable. Accounts payable is our liability. It shows we have to pay for those later. And so we're going to credit accounts payable. What we're going to do next is post this transaction to the general ledger. And we do that 1 line at a time. And you can imagine how tedious this would get if you were posting 10,000 transactions in a month. Luckily, the computer does it for us. We just have to click the button that says post, and it does it for us. But this is what's happening in the background. We're told to enter a debit balance of $400. So at the beginning of the month, and this is the supplies account, you can see that here. We can see the account number 15. It starts with a 1, which we would expect for an asset. And we had $400 worth of supplies at the beginning of the month. This is journal page 73. So when we, it wants us to put a check mark there, sorry. Place a check mark in the posting reference column for the opening balance. So we've checked that, we know that's the correct balance. And I have 1 minute left. Now we need to post, and we start with, again, we do one line at a time. So we're going to post this supplies line. So what happened? We debited $22.50 to supplies. So this first set of debit credit columns is to record the transaction, what happened. And then the second set, you can see they're labeled balance. We need to update our balance. We had $400 worth of supplies. Now we bought another $22.50. And so after that transaction, we have $26.50. That's our ending balance. In the posting reference column, we put, where did that come from? This came from page 73. So sometimes you might see a reference that says J73 to tell you it came from the journal, because although we're not going to be using them in this class, there are more than one, there's more than one kind of journal. And so sometimes you have to know which journal it came from. But for this class, we're only using a general journal. So we just say it came from page 73. How did I know that? It's right here, page 73. So anyone looking at the supplies account and wonders, what happened there? Why did our supplies go up so much? They can go back to journal page 73 and see, oh, we bought some. And there's probably an explanation that says invoice number 2750 purchased from Staples or whatever. Okay. Now we go back to the journal and we post, where did it go? What did we do with that line? We put it in account 15. We are out of time for today. I'm going to ask you to post the accounts payable line on your own. I'm going to stay and do it right now. So if you have a few extra minutes and want to do that right now, you can feel free to do that. Otherwise, if you need to go, that's fine too. And you can use the show me how and the check my work to make sure you do the accounts payable part correctly. And when we come in on Monday, we will start with exercise 9. Obviously, if questions about this, I would answer them. If you want to stick around and do your accounts payable part, feel free to do that.
Will you have the extra bit that you, the accounts payable, will you put it onto the recording as well?
I will keep the recording going till I'm done. Yes, good question.
Okay, great, thank you.
You too, thanks. Okay, so to finish this up for the recording, what I did was entered the balance and put the check mark there to say, yep, that's where we're good. Everything else after this is new. I posted the $22.50 credit that came from journal page 73, and I updated my balance in the accounts payable to be $20,550. Then I came back up to the general journal and put the posting reference, which is account number 21. The very last thing is to answer this final question, letter E. Do the rules of debit and credit apply to all companies? And the answer is yes. Yes, they do. So some of what we're learning in this semester, financial accounting, is specifically for publicly traded companies that are required to prepare and have audited and share with the public their financial statements. But even private companies are still using debits and credits and need to follow the rules of at least 2 accounts, 1 debited, 1 credited, and so on. You get my green check marks in there. And if anyone has any questions, I'd be happy to answer them. Otherwise, I will stop the recording for today.